Hi friends, welcome back everyone to Angel Trading Friend, and this is Prince here once again. So friends, as promised, I am going to explain to you today a swing trading strategy. You can also call it as a positional trading strategy. You will get the backtested data from 2008 with full indicators, with full parameters. Also, I will tell you how the strategy has to be done. Exact full details is available in this video. So stay tuned till end of the video. You will be getting full updates. Friends, this strategy is for positional. You can also call it as swing trading or as well as positional trading. Now, why is this? I am starting off with the swing trading strategies because, as I told you, intraday is almost going to get over. So, from September, there is, I don't think there is no more intraday. This is the news as of now. We don't know what is going to happen in the future. But then why do you want to struggle for a 1%, 2% or 3% intraday profits? Because the margin the fund required is going to be the same even if you're doing positional as well as intraday. So when you do your positional, you can run your profits, that is you can wait for 10, 15, 20 percent kind of profits. Okay, and once your stop loss hits, you can then look into a short trade or something like that. So always swing trading or position trading is better when compared to intraday if at all you are not having leverage. Okay, so now friends, so let me come back to the strategy. This strategy I have tested it on Nifty. I have been trading it on Nifty, and this is used by many professionals, many property desks. Many of them use this strategy, and it's something related to emotions of people, or you can say the behavior of people. So we try to understand the behavior of people and then we take the trade, and it's going to be completely systematic. It's a rule based trading. There's nothing discretionary, nothing of that sort. Entry, exit, stop loss, trailing of stop loss, money management, everything is going to be rule based. Okay, and also let me tell you, this strategy can be used in equities, it can be used in commodities, it can be used in bank nifty, anything. You already know how to find out trending stocks and all those things, right? You had watched my previous video. In case if you are not yet watched, I'll again give it on the iCard. You can just click on the iCard and then check the video. And also friends, this strategy which I'm going to explain to you is going to be a trending strategy. So what do you mean by trending strategy? We make money whenever market goes up, or we make money whenever market comes down. So whenever market moves sideways, we will be making a loss. So that loss is going to be limited. I'll explain to you how much is going to be the stop loss. So whenever the market is sideways, you can stay away from this strategy. And how do you know when the market is sideways? For example, presently market is sideways and continuous stop losses are being hit. In case if you want to stay away from this, you can, but you have to do your technical analysis, and I already explained to you how to find out the trend, how to find with the example of Nifty itself I had given to you. Okay, so you can watch that previous video. Okay, so and one more thing, do your back test. It's not that just because I did back test, just because I am confident, it's not that you also should get the same confidence. Friends, there's one saying, I don't know, I can't repeat the same thing exactly. A borrowed conviction is very dangerous. Okay, so I am having conviction on the strategy, I am very confident on the strategy. That is because I have backtested myself, I have calculated all the parameters, the profit factors, the biggest win, the risk reward ratios, the profit factor, expectancy, everything I have calculated. That is why I am confident. So I request you also to do the back test. I will also share my backtested file to you. You can WhatsApp on my customer care number 8095876525 and collect it as well. But apart from that, you also do your back test. You will get tremendous confidence, and let me tell you, even if you get continuous losses also, it will not even bother you, it will not even hurt you. That is the reason why I am saying please do your back test and trade for yourself. Okay friends, so if you really like the video and if at all you like the strategy what I'm explaining to you, then please don't forget to press the like button as well, and in case if you're still not subscribed, please do press the subscribe button. And now let's jump into the Excel and try to understand what it is all about. Okay, so this is the back test of the strategy. So as I told you, it's in Nifty future. I've done it from 2008 and I've done till complete. I tested in 2020 as well. Problem with 2020 is it's almost giving 100% returns in just single year, because you know that big spike which happened, market went down and then again market went up. So then I have avoided 2020, and 2021 is running as of now, and this is a position strategy. We hardly get some might be one trade or two trades per month. That's it. Okay, so I have tested till 2019. 2020 is 100% return, so I don't want such big figures to add and make it more lucrative or something like that. So, capital started with 1 lakh, has ended up with almost profit of 10 lakh 20,000 rupees. Okay, so this is the beauty of this strategy. Okay, so let us first understand what the strategy is all about, and then might be we look into all these parameters, the backtested data, so that you'll get a better understanding. Fine. Okay, now let me just explain to you first a candle. Okay, a typical candle. Okay, so let's say this is the open and this is the close. So this is going to be the low and this is going to be the high. We all are aware of all this. Okay. Okay, I think I have used the temporary one. Okay, never mind. I'll do one thing. I'll just show the chart itself for you so that you'll be better. Okay, perfect. So this is the charts. When you look into the charts, you'll understand. I've taken the daily charts. So whenever we are going to trade, we are going to see only end of the day. We are not going to take in between or anything of that sort. So stop losses can hit anytime between the day. So you can just keep your stop losses before in advance. But entries are always going to be towards end of the day. So if you are working also, you can stick to the strategy. You can also observe the strategy. Okay, friends. So most of you will be knowing what is a gap. Okay, so you can see here a candle is opening here, a candle is closing here, but next day it is opening somewhere here and then closing here. So everyone will call this as a gap, which everybody will be knowing. But then friends, there is something which many people don't know. There is something called as exhaust gap. Okay, I don't know if you have heard it or not. It's a professional term which many people use. It's called as exhaust gap. So there are two types of exhaust gap, that is up exhaust gap and down exhaust gap. Okay, so let me explain to you what is this exhaust gas all about. Exhaust gap, sorry. Now in this particular candle, let us see. You can see that the open price is 10881 and the close price is 10910. So next day you can see it has formed a normal candle, so nobody will call this as a gap, but this is an exhaust gap. I'll explain to you. You can see the close price here, the close price and the high price. You can find here the close price and the high price. There is a gap between the close price and the high price. This is called as the exhaust gap. What psychologically it means is that even though the previous day the market has closed at such a range, the next day it was not able to cross this level. So it means that there is a lot of pressure here for selling. It is not allowing the price to go above this. So yesterday it closed at this price, but today and this particular day the high was not able to cross the previous day close. So that means this is a exhaust gap, that is down. Okay, so you can see that it has gone down and this is an exhaust gap down. Okay, so I'll just put into the Excel so that you'll understand. So gap up and gap down, these two things friends, if you understand and if you start observing, you will get a very good idea as to how the market works, how the behavior of people is, how the psychology is really. Okay, so in this you can see that is yesterday's close is greater than today's high. This is what we are going to observe. If yesterday's close is greater than today's high, so every day you can just keep alarm at around 3:15 to 3:20 and just observe if today's high, if it is still lower than yesterday's close, that means there is a exhaust gap down and it means that there is lot of selling pressure and this is the time when we have to sell. Okay, So whenever we find these kind of exhaust gaps down, we will sell at the close price. So close price is somewhere here. Okay, so we will sell over here. Okay, now that is one example. Next, I will give you example of exhaust gap up. So here you can see open is here, close is over here. Okay, you are only observing related to the close only. Okay, mind you, only the close. Next day you can see the low has not crossed below the previous day close. So this is nothing but exhaust gap up. So the next day the pressure is to go up, it is not allowing the market to come down. So that is why you can see this gap. This is already having a gap as well as an exhaust gap. Hope I am not confusing you. I will just write it in Excel as well. So in gap up case, it is yesterday's close is less than today's low. These two concepts you just have to learn it, friends. This is something, I don't know if you have heard it or what, but this is something very special, and you can see the magic. You can start observing even in stocks as well as in commodities as well as in futures as well as in bank nifties. You will find that it works like beauty. A very good accuracy on this. It's nothing but the psychology of people. This is what you have to observe in a chart. You know that charts speak a lot to you. Yes. So you just have to observe these kind of patterns, and let me tell you, it will really give you very good figures, very good returns as well. Okay. So what does a gap up means? In gap up, the yesterday's close is still lesser than today's low. Okay. So that means the market is going up, and in gap down case, it is like if yesterday's close is greater than today's high. So it means it's a gap down. So our strategy is, whenever we find a gap up, we will buy the future or the stock or whatever it is. If you are selling a stock, then you have to sell it in future, but then if you are buying a stock, you can buy in equity or in future, anything. Okay. So gap up, whenever you find a gap up, you will buy the future. Let us stick to Nifty now. Whenever you find a gap up, you will buy Nifty future. Fine. And then we will wait till a gap down day comes. Till a gap down day comes, we will be trading in that, and also there is a stop loss. I'll tell you separately, but the actual logic is you will continue till the gap down comes, and whenever gap down comes, you will just stop and reverse. It's also called as SAR. You would have heard this concept in many places. This is also very famous. This is called as SAR, stop and reverse. So whenever end of the day, if you find a gap up, you are going to buy the stock, buy the future, and then when you find that there is a gap down any day, just immediately you can reverse the trade and you can continue trade in the opposite direction. So it means that full time your money is engaged, either you are bullish or either you are bearish. Perfect. Hope you got it. I'll just show you the Excel so that you will get basic idea. I'll do one thing. I'll take 2019 start itself. Okay. 2019, let's say, now this is the entry date and the rate of entry. This is the exit rate and the exit date. So everything detail I have mentioned in this Excel, you can just go through. You can do it yourself as well. Let us come to 2nd Jan. Okay. So in 2nd Jan, friends, as I already told you, this is an exhaust gap down. That is, it is the high over here is lower than the previous day close. Nothing but the previous day close is greater than today's high. So on this particular day, at the close value, we are going to enter. The close value you can see is 10,792. Okay, so entry rate is 10,790. Okay, from the chart to this Excel, there might be plus or minus 2 to 5 rupees, because this is done with the help of algo. So, and Zerodha chart data might be different. So, around 2 to 5 rupees difference will always be there. You have to accept it, but we are trying to understand the overall logic. Perfect. Okay. Now, the exit date is on 7th Jan, and then you can see immediately on 7th Jan, we have taken the reverse trade. We have entered at 10,775, and the 5 rupees difference have taken as slippage. Perfect. And 7th Jan, I will just show you. 7th Jan, we are exiting the trade and we are reversing. That means you can see here we are going long. In the trade type also you can see here we are short and we are long. So, initially we were short till 7th, and 7th immediately we went long. Now, why did we go long on 7th? For that you have to look into the chart. Now, where is 7th? Yes, perfect. So, 7th you can see that is the low is greater than the previous day close. So, this is the previous day close and this is the present day low. So, you can see there is a gap, because of which it is indicating that the market is bullish. So, immediately I close the existing trade, we can see we were in good profits, and then immediately I took the opposite direction. So, that is what you can see on 7th Jan we have taken okay, 7 Jan I have gone long. Now you can see till 22nd Jan there was nothing, I just had to continue. The market was bullish, it was continuing, it was just going. And on 22nd Jan, you can see at 22nd Jan, you can see the previous day closes over here, you can see the gap, and today the difference, you can see the gap here. This is called the exhaust gap down. Have you observed so many years this kind of readings? This clearly indicates that there is a lot of pressure to sell in the market. You can see how it is crashing down after that. Friends, please do analyze the charts. Chart speaks a lot to you, and this is one of my observation which many else also are following, else also have observed. You can also just observe for yourself and it speaks a lot to you. Yes, so that is what again we have done. We have just gone short on 22nd. Okay, so friends, this is all about the strategy, very simple. And one more thing which I have to explain to you. So initially this is what I was following. Whenever we get a gap up I used to buy, and when I used to wait till whenever we get a gap down I used to sell. But then later with the help of algo I was able to analyze that if at all we are keeping a stop loss of 2.1%, we can increase the returns very nicely. That is, in case if the market is trending very nicely, or if it is crashing or something, you don't have to wait till the gap up or gap down happens. You can exit whenever you get a 2.1% stop loss. Okay, so this 2.1 stop loss is the nearest from the close value. Whenever you find that it is from the previous day it has moved almost 2%, you can exit the trade. Okay, that is one thing, stop loss you have to keep in mind. Now let us look into the figures. I have done the full calculations, all parameters which has to be checked I have done. Okay, so total trades were around 513, out of which the losing trade and the winning trade, this is nothing but you can see almost 40% accuracy is there. So in a swing trading strategy 40% is more than enough. Reason because risk reward is almost 2.44. That means every time when you lose 1 rupee, when you are gaining profits, you will be gaining around 2.44 rupees. That is the beauty. That is why even if you have a success rate of 40% also, you are going to make money. Now the average winners is 11,000. This is what I was telling, and the average losers is only 4,000 rupees. So I almost done all the parameters. Important one is expectancy, friends. It is 1,794. It means that in each trade you're going to make a profit of 1,794. That is nothing but the average of all the losses and the profit. So provided you trade every day, every order whichever get executed. Okay, so apart from that, important things, you can see the profit is around 9,20,000. It's very good. Uh, okay. Now this is the equity curve. You can see that is continuously from 2008 it is going up. There was hardly during only this phase you can see the market has moved sideways. But apart from that, all other year it has continuously gone up, and this is how we check the equity curve. This is the underwater curve, that is whenever we were making loss, how much losses we were making. So you can see in 2008 because of the huge volatility and crash we had a 14% loss, but apart from that it was all -4 in that range itself, -4 to -5% range. Yeah friends, I forgot to tell one more important thing. Yeah, drawdown, this is 15% theoretically. So always you have to expect the double, that is you can expect a drawdown of 30%, and also maximum loss in a row are 12. You have to be ready for all this. Okay, I don't know which year it has happened, I'll just check. It was 2012 or something, but you have to be ready for that. What this means that is that 12 times it has got continuously losses in a row, and that is how you trade in a systematic trading. What I have observed with many people is that as soon as you get 1% loss, I mean 2 times loss, 3 times loss, 4 times loss, they start thinking that, oh, the strategy is not working and then I have to stop trading. That is not correct. People, all those who are professionals, they know very well that even if you get, if your system says that you are getting continuously 12 losses, then you have to be ready for even 14, 15 kind of losses as well. You have to add extra. And also the MDD means maximum drawdown. It is almost 45,000 rupees. You have to be ready for accepting all these losses. Only then you will be able to make profits whenever you are doing a systematic trading. Okay. Yeah. Then I showed you this underwater curve, and this is the equity curve and the average. Okay, equity curve and equity average. Why do we do this is because, friends, sometimes whenever we are in a drawdown, if the market crashes or we are making any losses, if the profit, if the equity curve comes below the equity average, we have to stop trading. Many people were asking, when do you stop trading? When do you decide that you have got continuous losses or maximum losses? When do you stop trading? So this is one idea, friends. We stop trading whenever the equity curve goes below the equity curve average. So equity curve average is nothing but the average of all the previous days. So whenever this curve comes down below this average, we can pause for the moment and then do virtual trading, that is paper trading, and wait for the market to reverse back. Once if it reverses back, then we can re-enter into the trade. Yeah, so this is all about that. Other things I don't think parameters are required for you, but this is the more important thing. And the one more beauty is, in case if you are doing compounding. Okay, so capital required I have considered as 3,30,000 rupees, because Nifty future, if you have to buy positional, you almost need 2 lakh rupees. Okay, because you're not going to get any more leverage in the future. And then also considering the drawdowns, 3,30,000 rupees I have considered. And generally, if you trade with this, you can see the profit. Okay, it was coming to around 12,50,000. Now let us do the compounding and then show you. When you're doing compounding, there are two things which you can do. Either you start increasing with every 3,30,000, or you can keep something called as delta. So every time whenever you make a profit of 20,000 rupees into the lot size, you can increase one lot size. Okay. So once if you do compounding, this compounding I'll teach you again, friends, don't worry. The value goes much bigger. I don't even want to say it as well. It goes to 3 crores, 69 lakhs and all those things. But it's not practically human possible to do such kind of compounding. But at least what I'm trying to make you understand is that by doing compounding, theoretically also the profits are increasing double, triple, even if you consider slippages, even if you consider the gaps and gap down, everything, we can expect a very good return in this. And there is one more called as Kelly's formula as well. So if you follow Kelly also, you can do the Kelly is showing almost 15408% returns. Okay, so it's all very big returns, 4,327% in fixed ratio model. That is nothing but every 1 lakh you increase, or every 2 lakh you increase your capital, I mean your lot size, or every 3 lakhs you increase your lot size. Okay, so there are hell lot of opportunities, lot of possibilities for doing this trading and making it a better. But what you have to understand is, simple thing is, you have to stick to it for a long time. Okay, so hope I was able to make you clear the strategy, the concepts. Very simple. Just wait, observe the charts and find out the gap ups and gap down. Whenever you find a gap up, you can enter into the trade, and whenever you find a gap down, you can sell a trade, or you can go short, and then keep a stop loss of 2.1% from the close value. Okay, and friends, don't forget, you have to practice it first, do your back test first. You will find the magic, and then you can start trading. And also presently bank nifty, I mean Nifty or whatever it is, market is moving sideways. I already explained to you in the previous video. So till the market starts trending, you can do your practice in this, do your back test in this, or do this virtual trading. And once market starts trending, you can observe it in the technique which I told you. Once you find market is trending, then you can enter into your trade as well. Okay friends, hope you like the video. Don't forget to press the like button, and in case if you want this backtested file, you can just WhatsApp on our number, customer care number. It's 8095 876525. Thank you. Have a nice day.